Hello, everyone. Thanks for joining us. My name is Tony Campos. I'm head of sustainable investment at FTSE Russell. We're delighted to have you with us today. Look forward to a terrific conversation. And we're going to have David Russell, who's the chair of the Transition Pathway Initiative, or TPI, joining us today. David, hi, how are you doing?
I'm good, thanks. Hello from New York as well. I'm here for New York Climate Week.
Certainly a busy, exciting week here. Thanks for taking the time to talk with us a little bit. Maybe before we get into it, David, could you just introduce yourself a little bit?
Sure, and good morning, everyone. For most of you, I think, are in Australia or New Zealand. I'm David Russell. I'm currently chair of TPI Limited, the asset owner-led part of the Transition Pathway Initiative, which I've been doing for just over a year. Prior to that, I spent a number of years working as an asset owner. I was head of responsible investment for USS, the largest UK pension fund by assets, and got to do all the things an asset owner does, particularly one with an in-house manager. So engaging with companies, engaging with policymakers, helping our managers integrate ESG and climate change issues into their investment decision-making process. And as part of that, USS were one of the founding organizations that set up TPI in 2016. And I've had a few other roles as well, but I think that's enough for the moment.
So certainly a lot of experience and knowledge to add to our conversation today on leveraging data and indices for a low carbon transition. So we're going to hear a bit more from David momentarily, but I thought we'd kind of start with a bit of scene setting and informed by a recent survey that was published by FTSE Russell just a few days ago, actually. This is a global survey of asset owners on sustainable investment. So we thought this would be a good sort of scene setter for the conversation around data, indices, and the low carbon transition, as we'll see a couple themes that are very prominently featured in the survey results. So again, this is a survey of asset owners globally. Now, we look at around 300 asset owner respondents in this year's survey. This is the 8th year that FTSE Russell is publishing the results. So we've got a good set of feedback from global asset owners. And the results this year really show that asset owners are increasingly positive about the impact of sustainable investment regulation, increasingly positive about data, and we're seeing increased adoption for passive strategies in terms of implementation. And as we'll talk about as well, climate very much prominent on the agenda. So the first thing maybe just to highlight here, and you can see all the bullets on the slide, is to say, sustainable investment firmly in the mainstream for asset owners. About 74% say they're implementing or evaluating sustainable investment as part of their investment strategy. Now, that is a year-on-year sort of downward tick. Last year, I think it was in a sort of low 80s or high 70s%. But again, that's over 3/4. And I think in response to a lot of the headwinds that many investors were facing, and certainly in some parts of the world, a bit of pushback on sustainable investment. That's a really strong number to show asset owners are very much committed here. One of the more interesting aspects of the survey was, asset owners responding positively around regulations related to sustainable investment. So 90% said that sustainable investment and ESG regulations help them meet their sustainable investment goals. So I think with, there's a wide range of regulatory and policy initiatives that are impacting investors. I think for the asset owner community, they're probably seeing a lot of expecting a lot of benefits in terms of improved data, improved transparency, and ultimately a positive sentiment around the impact that will have on them. When we asked about barriers, what are some of the biggest barriers to sustainable investment? One of the themes of today's talk, data, was probably the most interesting result here. Since we've been running the survey and asking this question specifically in the survey since 2001, the number one cited concern has always been the availability of ESG data and the use of estimated data. Top concern. This year, that fell to 6th place, and the most common barriers cited were around methodologies and resources, so internal resources for asset owners. We're going to spend a lot of time talking about data and methodologies, how that's informing decision making, but also what we're seeing here in the survey is, I think, a recognition that There is a lot of data available. Of course, it needs to be refined and improved. We need not just sort of higher quality, but even better quantity as well. But I think this shows there's a critical mass of data available. Finally, climate. 90% of asset owners said they're concerned, or in some other stronger language, more than concerned on climate risk and the investment impact. It shows certainly consistent with our experience in the market. So I'm going to hand over to David with that, having been a bit of a scene setter. Again, we'll pick up on these themes all around climate transition. We're going to talk data, we'll talk methodologies, and we'll certainly touch back on that passive implementation point as well. But for now, David, over to you to talk a little bit more about TPI, the data, and all the work that you do.
Great, thanks, Tony. And apologies if the lights go out. The room's on a PIR, so every so often, if I don't wave my arms around or move, it goes dark. So hopefully, won't do it again while we're talking now. I'm going to run through a bit of the background about TPI and how the data are collected, and what the analysis does, and also outputs of a piece of research that was published only last week, the State of Transition report. So, taking a step back. 2015, the Paris COP, transition became the buzzword, and a group of UK pension funds were being presented at by companies saying how fantastic their transition plans were. We should trust the companies in what they were doing, but we had no way of testing or assessing how good those transition plans were, and that led to the formation of the TPI. The group of asset owners and some asset managers began work with the London School of Economics, Professor Simon Dietz, and working with him to develop a process for assessing how companies were transitioning, or the plans they had in place for transitioning. We also formed a partnership at that point with FTSE Russell, who became our data provider, and that partnership still exists now. TPI now is an asset owner-led organisation. TPI Limited is an asset owner board, and that's what I'm chair of. And we also have the TPI Centre as a research partner, still part of the London School of Economics, and that has grown from Simon Dietz and a couple of analysts to now 27 people who work on TPI and TPI-related analysis. TPI data and assessments are based on public data. It's not a questionnaire that's sent to companies and a black box of analysis that comes back. We rely specifically on public data. That has its limitations, which I may cover later. But it means that individual investors can also get hold of the data, because it's based on public disclosures. The processes we use are also public. So on the TPI website, you'll find the methodologies we use, the thinking behind them. And as we develop new methodologies, there's a public consultation about how the processes will develop in the future. And finally, TPI is an open access tool. If you go to the website, you can find the results of our analysis on both companies and sovereigns, and that's part of the core thinking behind the TPI. The group of asset owners that set it up didn't want another data set that was just used by a small number of investors. What we wanted was as many people as possible to be using the data, because you have to remember the ultimate aim here is to address climate change, because that's a risk to investors. And the more investors that are using data like TPI to address that risk, the more likely the risk is going to be addressed. So that's why it's an open access tool. So TPI has two assessment processes. One is the management quality, the MQ score, which you can kind of think of as an assessment of the governance of TPI. And the second assessment process is carbon performance, which looks at how companies are the targets that companies are putting in place are aligned with transition pathways. And I'll go into a bit of detail about each of these over the next few slides. So management quality. Now, as I said, it's an assessment of governance of how companies are transitioning on 6 different levels, and the level 5, the 6th level, somewhat confusingly, was only added last year. What it does is it sets a stepwise framework for assessing how companies are, what processes companies have in place to manage their transition. And it starts at level 0, where basically the companies have no disclosure and there's no information about how they are transitioning, up to level 5, which was, as I say, only introduced last year, which is a much higher level of analysis and much greater expectations. To go up the levels, and there are 23 questions in the current version 5 of the assessment. To get to the next level, you have to fulfill all the requirements in level 2 if you're going to be ranked to level 3, and level 3 to get to level 4. You don't get up unless you clear all the different levels. And as I said, FTSE is the data provider. I think on level 5, what we were finding up to last year is that we were getting a clustering of companies in levels 3 and level 4, because companies are have quite clever people working for them, and they were using TPI as a checklist to go up the framework. So we introduced some more challenging questions, particularly ones that focus more on how companies are putting in place transition plans. And that is an important evolution of TPI. When TPI started, there were no transition plans available. It was all about process. And we've now got to the point where companies are putting in place transition plans, being legally required to in certain markets. So we're looking at how we can assess transition plans in greater detail. We're also looking at level 5 in how companies are using offsets, if they're using them. How they're dealing with CapEx. Are they phasing out CapEx in carbon heavy activities, or putting more CapEx into transitioning, and how they're dealing with their trade associations, because as you'll all know, frequently the policies of and public disclosures of companies are not necessarily aligned with what their trade associations are saying around climate change. So there's a lot more complexity in that level 5. Carbon performance looks at something slightly differently. It assesses how companies are transitioning against 3 different types of scenarios. A national pledges, the Indices pledges, which is roughly 2.8 degrees of temperature rise, below 2 degrees, and 1.5 degree aligned. And it assesses how companies' targets are aligned over the short, medium, and long term within those transition bandings, as you can see in the chart on the left of my screen. So company A here, the red dotted line, is aligned, and company C is above the line in all cases, so it isn't aligned. It's slightly more complex than that because you have different time frames, short, medium, long term. But it gives you an idea of how well the company's aligned with sector-specific transition pathways. So this chart would be slightly different for the colour bandings in the chart would be slightly different for cement compared to oil and gas compared to steel, because each of the different sectors has a different transition pathway, and those transition pathways, which are developed by TPI, are built around IEA transitions. And you can see the number of high emitting sectors that are covered there. Food producers was the last one published, and that was published earlier in the year. And I think another important point is that I mentioned short, medium, and long term. What we're finding is companies tend to have long-term targets, but are not putting in place short-term targets, short and medium-term targets. And the challenge here is the science shows that emissions early on are really important because they're cumulative, they build up in the atmosphere. So unless a company is beginning along its transition pathway now, they'll be putting more CO2 in the atmosphere that will always be there as the company transitions later. So you need an earlier pathway, transition pathway, to make sure that we get to net zero by 2050 or Paris aligned by 2050. What we're seeing, as I said, is companies are setting targets into the future, but not necessarily putting things in place now to make sure that they're going to get there. So as you as investors need to look at how not only where their end target is, but how they're going to get there and what their transition is over the short, medium, and long term. Oh, this one's got transitions in. I'm going to click them through so they're all there. And this is just to give you an idea of the breadth of coverage of TPI. So on that management quality score, which is, as I said, based on FTSE data, currently the assessment is on 1,000 companies. That will go to 2,000 companies in the next month or so. We'll publish an updated set of data. And longer term, we're hoping to get that into the many thousands. Carbon performance is currently at 410 companies across those 11 sectors. And the reason why that's a lower number is that that's a much more data intensive activity. And the analysts at the LSE, the TPI Centre, I spent a lot of time making sure the data are correct, collecting the data, and then analysing it. So that's currently a lower number, but we'll go up from 410 to 550 this year. And again, the plan is to increase that in the future. Just so that you're aware, the TPI also provides the information for the CA100 company net zero benchmark, and has been providing that since the early days of CA100 Plus. That's currently roughly 150 companies, going up slightly by roughly 10% this year. And that's another strand of the work that TPI does. We've also focused on banking, and banking's important because it's one of the key funding areas for companies to do things. You've got credit on one side, so corporate debt. The other side, you've got banks. And what we want to see is how are banks funding the transition with their loan books, or are they funding not transitioning? So there's a lot of work focusing on that. That's currently 26 banks, going up to 40 later in the year. And finally, ASCOR, which is assessing sovereign climate opportunity and risk, which is a separate project looking at how countries are transitioning. So initially the focus was mainly on the sovereign debt side, obviously an important asset allocation for many investors. But it's also important from a corporate side, because companies are based in countries, and if countries aren't transitioning, companies aren't likely to be transitioning. So that link has become quite important. That's currently 25 and will go up to 70 by the end of the year. So that's a kind of overview of where the kind of level of data that's being published at the moment. The plan is to increase all of them, not just this year, but also in years in the future. Very briefly, we have 153 supporters around the world, of which I believe 8 or 9 are Australian funds. And we always plan to increase that and get more people to officially support TPI. Yeah. I mentioned earlier that TPI published a state of transition report last week, or the week before. And I'm going to run through the very high level analysis of the outputs of that assessment. So the report covered the 1,000 companies that are in the MQ management quality data set, which focuses on those high emitting sectors, which you can see listed in the blue box. And within those sectors, we also focus on the largest companies, the largest market cap companies. With the management quality score, that's 35% of global listed equity, but 100% within the high emitting sectors. And on carbon performance, while it's a lower percentage because of that data availability and the more difficulties in assessing the data. And I'm not going to go through all the stats, but you can see how many companies in each sector were assessed against the different MQ and CP data. Yeah. High level, the results were, if you remember on the management quality staircase, the average kind of score is now level 3. And some of the TPI is obviously a Gulf supporter, so that's a par score for them. So most of them are beginning to address climate change on scope 1 and 2 emissions only. Very little still available on scope 3. but that's kind of it's a slow increase and slow improvement over time in terms of where companies are sitting. So many companies are doing more, but they're still not strategically assessing climate change. If they were, they would be scoring a level 4 and particularly a level 5. So whilst yes, it's good to have companies sitting in that level 3, they're beginning to address it. There's still a long way to go. In carbon performance, there's been quite an increase in those who have alignment with Paris, and I think the number was 30% had a long-term target for Paris alignment, so that's 2050. That's up from 7% the last time we did one of these assessments, which is in 2021. COVID kind of got in the way in the middle of that. So there has been a marked increase in those long-term targets. But what that also means is most companies aren't aligned, 70% still aligned, and that's at the long-term target. The short and medium-term targets, there's even fewer companies aligned. One of the other aspects of the TPI State of Transition report that I thought important to highlight was that we also looked at analysis linking the ASCOR, the sovereign debt-focused, country assessment-focused research, and the corporate research. And this is important because of the emerging market issue, and I'll come back to that in a moment. The results of that were basically company location matters. If you're located in some countries, you're going to have lower score, and that usually links an emerging market company and country versus a developed market company and country. What this means is you have to think about how people frequently use ESG and climate scoring data. They tend to overweight the good performers and underweight the bad performers. And the logic there, it makes sense, but what you end up doing is, because you're biasing against emerging market companies, and this isn't just TPI data, this is all data that's based on publicly available information. Emerging market countries tend to have lower levels of regulation around disclosures by companies, and that would include climate data and transition data. So if you're basing your analysis on publicly available data, there just is less of it in emerging markets. But what that means is if you're tilting your portfolios away from poor scorers towards better performance, you're biasing your portfolio against emerging markets, and they're the companies and countries that will need the financial support most to transition. So I think that it's been useful for ASCOR and TPI data to come together to be able to demonstrate that, so we can start to think about how we move away from that bias and stop and move away from potentially not funding TPI. I think I can leave it there. There's a few more slides, but I think we're easing into time.
Great. Well, thanks, David. And we got a question through, as you were presenting, and thank you for that. It reminded me as well that I forgot to mention you can send your questions through just by clicking the Ask Question button, and we'll get to them. So one question here, David, was around how the framework has integrated any materiality analysis for MQ or CP.
So I'm not 100% sure I understand the question, but the way that the TPI has selected the sectors is it is focusing on those companies and sectors that are high emitting. Therefore, in any future world where we see tighter climate regulation, carbon emissions being limited, more focus on renewable energy away from fossil fuel energy. Climate change is always going to be material to those companies. Therefore, it's the materiality of climate is built into the assessment of the sectors that TPI has been assessing. I'm not sure that answers the question, but that's how I kind of read the question.
Certainly makes sense to me. Thank you, David. So we'll save a little bit of time as well at the end for questions. So be sure to send those through. But we did want to talk a little bit about kind of real world uses of the data. coming from TPI, and particularly how investors have been using the data. One of those, you mentioned FTSE Russell's role as a data provider. So that means we're going out and collecting this publicly disclosed information from the corporate sources. And against those 23 indicators David was talking about for management quality, that populates the different levels across the corporate research universe. But we also have a role to play as an index provider. And I wanted to start maybe with talking a little bit about how the data is used in indexes by asset owners. And then David, maybe I'll hand back to you to talk a little bit about, sort of some of the use cases beyond just the index. So in 2020, we launched together with TPI our first equity index in what's called now the FTSE TPI Climate Transition Index Series. That work was done by one of the founding TPI supporters, the Church of England pension fund. And the basic idea there was one of transition of a different nature. It was sort of an asset transition from a portfolio perspective. They wanted to take some of the data and concepts that were being applied to the TPI methodology and reflect that in their portfolio, particularly among some of their core passive equity allocations, that were tracking the traditional market cap weighted benchmarks. So in this case, it was a developed market benchmark. And I think at the time they moved essentially all of that out of the traditional market cap weighted index into the FTSE TPI climate transition version. As I said, that was about in 2020, and that I believe that allocation was around 600 billion pounds, 600 million pounds, I should say, just to be clear. If we fast forward to today, we've got well over 20 indices across the TPI series and another handful or so that use the same sort of framework of data application for custom index design. And we've got north of 30 billion in assets passively tracking those indexes. So we've seen a pretty strong adoption and uptake. And what some of those clients and usages have in common, I think, is sort of reflective of kind of what's happening amongst this group, particularly the asset owner community that's focused on transition investing. Is in order to achieve the kind of scale of capital allocation that is sort of that they sit on and want to motivate and sort of drive behind, that means it has to reach sort of all corners of your portfolio over time. But some of the biggest chunks of that allocation are going to sit in traditional passive equity and fixed income portfolios. So ultimately, that money that's moving is already allocated. It's already got sort of risk budget, return expectations. It serves a purpose within the portfolio. So when we're transitioning those assets to a climate transition version of an index, we can't disrupt that too severely. So it's very important that the indexes maintain risk return characteristics that are similar to the traditional market cap weighted index. So we talked about Church of England, but many of the other asset owners that have been adopting these indices, including Brunel Pension Plan in the UK, the New York State Common Retirement Fund in the United States. Essentially, all of them have some common goals, which is around improving the climate metrics, but also maintaining a reasonable risk return profile. So what we've seen consistently, these are all usually developed market or U.S. market benchmarks, is sort of tracking error running in the sort of 150 to 200 basis points range, slight outperformance over the 11 years of back-tested history that we have, and improvements across all of the kind of climate metrics that we're focused on, the management quality scores, the carbon performance scores, but also things like carbon emissions reduction, fossil fuel reserve exposure reduction, and increasing our exposure to companies that are generating revenue from green products and services. So in that way, we're combining the TPI data on management quality and carbon performance with other traditional climate data sets that FTSE Russell has, like carbon emissions, fossil fuel reserves, and green revenues, to get a more holistic view at risk and opportunities, putting that together in an index weighting methodology that, again, is meant to deliver a outcome, and characteristics that are similar to the market cap weighted version of these broad market benchmarks, because ultimately that is where the money is currently tracking, and it's moving over into these climate transition indexes. There's a lot more that sort of features underneath that overall shape of the story, including how the data gets used independent of the index. There's a stewardship and engagement angle, but maybe I'd pause there and hand back to you, David, to talk about some of those other aspects. But I hope that was useful for the audience to hear around the index application.
Sure, thank you, Tony. I mean, I think it's critical that there are multiple uses for TPI data. Tony's talked about the use in setting benchmarks and running indices against them. And I've also touched on the engagement side by pointing out that, and stewardship side by pointing out that TPI provide the data for the CA100 Plus, which is, I'm assuming most people will know, but just in case, it's a global initiative with around 650 investors from around the world who are engaging with the 100 plus largest emitting companies in all sectors around the world, the high emitting sectors. So stewardship is a key focus for the use of TPI, both at that collaborative level, but also amongst individual investors who are engaging with their holdings in various markets around the world. And the usefulness of TPI is it also tracks how companies are changing over time. So there's now a history from 2017 for some companies, but each year the analysis comes out that the number of companies has gone up. So you can track how companies have performed over time. And in my former role at USS, I was co-lead of the engagement with Royal Dutch Shell now, in 2018, 2019, 2021, where we were using the TPI data to discuss how the company was transitioning. Sadly, the company has gone backwards in recent years with changing management, changing board, geopolitics, but they were actually doing quite a lot of work on transition planning then. So it's very useful to be able to say, this is where you were last year, this is where you need to go, how are you going to get there? The data are also being used in terms of integrating into investment decision. The lights just got off, by the way. Investment decision-making processes, where I know fund managers, active fund managers, are taking TPI data and also their discussions with companies, so they can build that into the views they have, the models they have around how companies are transitioning. So they're kind of the two of the key ways in which TPI data are being used. And they can also be used in terms of screening as well. Some investors are using TPI data to guide their whether they hold companies or not, based on the idea that we will support companies that are transitioning, and TPI data can help identify those companies that are transitioning. The flip side of that is you don't support companies that are not transitioning. And we've seen a number of large investors around the world say, okay, the evidence isn't there that the companies in this sector or these companies in this sector are transitioning, so we will divest from them until they can demonstrate that they are transitioning. So it sends a strong message to the companies. So that's kind of three different ways in which investors are using TPI data currently. Just to add one thing, the ASCOR data are also useful for engaging with sovereigns. And I believe that PRI is running a program in Australia for engagement based on ASCOR data and engaging with the government around policy. The idea is that those data are used globally to engage with policymakers to make sure that they're putting in place transition suitable regulations to encourage their markets to transition.
So I think it's probably interesting maybe for the audience to think about, that engagement piece with sovereigns. I can remember, a time many years ago where it was thought that engagement and passive didn't really go together. And I want to make sure that we've certainly seen a change in sentiment and mentality there. And I think it's the same on the debt side to say, well, how do you engage in that asset class? Ultimately, I think the influence of investors, particularly the global asset owner community, is strong regardless of the asset classes they're holding and the structure of the investment. So that's great to hear, and certainly we've had consistent feedback from folks that have created mandates against the indexes, that the alignment of their stewardship goals and efforts with their portfolio decisions, gives them even more weight in the conversations that they're having with the corporates.
Yeah, one thing I would add is that TPI is also thinking about how we can move into other asset classes, and I think private assets is so private equity and other private assets are going to form up a strong part of that. One of the main reasons for that is not only because of private equities are obviously important holding, private assets are obviously an important holding for many funds, but it also links into the credit side, because most credit indices have a significant proportion of their constituents who are private. So if you want to address transition in credit, and credit is, as I said, like banks, that's one of the sources for funding to transition or not to transition. So understanding how the receivers of credit are transitioning is really important. We need to have more private companies being assessed. The challenge we have there is, if you're using a process that's based on public data, private companies are notoriously bad at providing any public data, let alone ESG data, let alone climate data, let alone transition data. So part of the onus on you as investors, asset owners, asset managers, is to encourage the holdings that you have that are private to be publishing more. And that could lead to discussions with regulators to kind of level the playing field. And this is something that we've had in the UK as was one of the discussions. There's a very strong push on public companies to provide data by shareholders. There's less of a push on private companies. But loads of those private companies will be held either in private equity funds or in credit portfolios. So surely we should be getting the same level of data from them. So it's something to think about in your engagement with your underlying private assets.
Absolutely. But, I think back to one of the comments I brought from the survey around, sort of availability of data and use of estimated data used to be this number one cited barrier for the last 3 years, and now isn't anymore. I certainly want folks to sort of feel that, that's not an excuse not to take action. There should be enough data. You can't wait for the data to be perfect. You can take actionable decisions on the data that we have. And certainly estimations and modeling are useful tools that we're seeing more investors getting comfortable with. As we're coming up a little bit closer to time here with about 7 minutes, want to make sure we get to some of the audience questions. And a few of you were thoughtful enough to send through questions even before the session started. So, David, maybe one for you, and then we'll on TPI, and then we'll get back to kind of the question of emerging markets that we talked about. So the question for you first, David, was around if we look at the kind of global landscape of decarbonization disclosures and initiatives, kind of, there's a lot of activity going on there, kind of why would, TPI be sort of different in helping to shape sort of that common global ground that we're all looking for?
Sure. I mean, I think this goes back to the early days of TPI. So TPI is significant. The carbon performance assessment is based on the targets companies are setting against sector-specific pathways. And the reason it was based on targets is because in 2016, 2017, 2018, companies simply didn't have transition plans. So we were putting in place something that was forward-looking rather than backward-looking. And my experience at USS was that if you were trying to assess climate change, you looked at a carbon footprint. So we did carbon footprints of the portfolio. And what that told us is we held cement, steel, airlines, sometimes oil and gas, sometimes mining. But the heavy users of fossil fuels were the ones that came to the top. That doesn't help us in terms of, okay, how are they going to perform in the future? So that was why the TPI was focused on what targets are they setting to get to net zero, to get to Paris alignment. Times have changed. We're now beginning to see transition plans come in different markets around different companies around the world. So TPI has had to evolve, hence the level 5 and the more focus on what companies are actually doing to transition, how they're funding that, what their capex is. I think in the future there will be even more focus on the details within transition plans, because that's the way that I think the market is going. But in terms of global markets, there are very few companies relative to the global market in terms of transition plans. I think we'll move there slowly, but I think that was the strength of TPI, is it's forward-looking as opposed to that backward-looking assessment of carbon footprints, which we all still do, or funds still do, because that's how you measure, or one of the key measures that TCFD reporting requires. But more important is, where are the companies that you are holding going, not where they were 2 years ago, perhaps 3 years ago, because that's when the last data were made available.
That makes sense, and certainly, sounds familiar from some of our work with clients on the index side, where kind of that combination of the traditional backward-looking data on emissions, on reserves, combined with the forward-looking data from TPI, helps give a holistic view that then sort of features in the way the indexes are created and weighted. And that was the second question we had, was sort of how emerging markets sort of play and factor in the indices. So I think there's a couple of things worth commenting on that question, which is, one, we do have emerging market benchmarks and emerging market coverage within the TPI Climate Transition Index family. Interestingly, pretty much all the client money that's tracking the indices that I was talking about earlier are on developed market or US portfolios. So we haven't had an EM allocation yet. An EM specific allocation. We have had an all world allocation, so that's developed and emerging together. But when you look at the EM versus DM sort of comparison, some of the data disclosure challenges that David talked about, I think help and will certainly shape some of the outcomes there. Essentially, the index objectives are the same as I talked about before. So it's about an alternative to the core market cap benchmark. The outcomes are similar, but generally a little bit more exaggerated. So the returns and tracking error are higher than in the developed market comparison. Your active share across industries and geographies also higher. So a little bit more concentration, but also things like the carbon emission reduction is higher. The concentration and distribution towards the top of the management quality scores, those higher levels that Dave was talking about, are higher. And those things also, just to tack on to say, we've started to look at country-specific versions of the indexes too, including for Australia and for New Zealand. So we do have those indexes live already, as well as a Japan version. And those tend to be, especially for a market like Australia, Canada is another example where, a smaller market with high focus and concentration in fossil fuels, tends to sort of, again, exaggerate some of those characteristics around the indexes. But, we've seen and been running those live indexes for some time. Conscious that we have only 1 minute left. So at the risk of bringing up a question and not being able to do it justice, I would suggest that we kind of bring to a close here. David, I know you mentioned you're spending your time in New York for Climate Week while we're recording this. Any final thoughts from you as we close?
Yeah, just that I'm actually coming down to Australia for those that are interested. I'm going to Hong Kong, so there'll be a session on TPI with the Asian Investor Group on climate change, and FTSE will be running a session as well. And then I get to, this is early November, I'm doing a session for FTSE in Sydney, and then going to the IGCC conference in Melbourne, and then speaking at the ICGN as well. So if you want to catch up and have more information about TPI, please look me up when I'm